Perfect. So we will just kick off with the unsecured funding masterclass. So thank you those joining us today, and also potentially watching this as a recorded session. We'll ensure to share this with all of our partners, prospective partners, as much as we can over the coming weeks. So just to introduce myself, I'm Tom Hawley. I head up our advisor lending team here at Swoop, focusing predominantly in the unsecured space. So my role specifically is to support our super advisor partners and their businesses in securing funding, which is obviously one of the major parts of what Swoop does, but by all means not the only thing, as we'll touch on slightly. So this session is geared towards some insight in terms of the different unsecured products that we support with. The goal of this session is to obviously highlight these products, but also to get you to start thinking around your potential clients and where these products would potentially be suitable. It's also about some of the questions that you could potentially ask your clients to uncover some of these potential opportunities as well. For those who are currently attending, please do shout out with any questions, use the Q&A or the chat. It's always best run as an interactive session, and the best way to learn about these products and what Swoop can do as an additional service line to your business is to ask those questions, is to give us inquiries, and to see where it is that we can help. Cool. So to kick off, so what is Swoop? So Swoop, what we're essentially trying to build here is a one-stop shop that allows access to multiple different finance products and savings products, should I say, as well, in the marketplace. So we are very, very broad in terms of what you do, and apologies if some of our attendees have had these initial calls, but to give a really quick insight in terms of the different products that we can look at and where our focus is, and before we jump into the secured side, I think is really important. So to begin with, I mean, one of our major and probably where we see the majority of inquiries is through the debt finance area of funding. And this is very, very broad within itself in terms of the different products and ways that we can support businesses, all the way from your early stage, your early stage businesses who may be looking at startup loans or initial invoice finance facilities to get themselves up and running, all the way to your potentially more established businesses, which will qualify for maybe a higher amount of products, whether that's asset finance, commercial mortgages, longer term loans, and so on. But we're very, very broad in terms of the options within the debt finance space. And it really, really just comes down to the business and what they're looking to potentially achieve at that stage, and obviously what product they would be eligible for, and so on. So that's one of the main areas. Secondly, grants, always a massive talking point for ourselves and the businesses that we support with. We have a specialist grants team that are consistently scouring the grant landscape for new and exciting opportunities where we can support businesses. That will all be accessible through our grant finder tool, which is through our platform, and gives some insight in terms of the kind of different products that we can the different grants, I should say, that we can look at. Savings, also a massive conversation point for a lot of businesses. What we're keen to do here at Swoop is not just be able to support the funding side, but also find other ways in which we can support businesses and clients in different ways. And savings is a massive part of that, whether it is your FX, your energy, or your current account utilization, or your deposit savings. There's lots of different ways that we can support clients. And the final one there, equity, is also a big part of what we do here. We work with a panel of investors to go and support businesses with different types of equity investments. You can see there the different types of investing individuals or kind of entities that we work with. So hopefully that gives a little bit of insight about the different types of products that we can support with here at Swoop. And the main ones that we're going to look at here today will include VAT and corp tax, business loan, merchant cash advance and other products as well that we run through. So perfect. So to jump into the next part of the presentation, there's a lot of talk at the moment with a lot of businesses that we work with and a lot of partners that we work with around the current state of play around funding and borrowing and so on for businesses. And I'm sure everybody is aware of what has happened over the last couple of years in terms of where the base rate has gone, ultimately the cost of borrowing, not just within the commercial space, but obviously across the board, whether that's personal as well. So the crux of the matter is that things are more expensive than what they were 2 years ago, and that is purely driven by the pretty substantial rise in base rate over the last couple of years, where it was sitting sub 1%, we're now sitting above 5%, and rates have pretty much gone in line with that. It might be that, pardon me, it might be that businesses, the last time that they were looking for funding was when they potentially through COVID, where there's some very, very favourable government schemes that were around in order to give businesses that security to continue trading through the pandemic, which is very, very well received by the majority of businesses. The terms that were available on those facilities were very, very favourable to the end borrower, and it's completely understandable because it was there to help businesses in obviously a pretty unique time. What that may have led to now is potentially distorted the view of what's out there in terms of the market. So things are, we've very much moved past the government support schemes. We have recently had the announcement of the recovery loan scheme replacement, which is the growth guarantee scheme. But that, as in its current form, is nowhere near as favourable as what we saw through the initial parts of the pandemic, through the bounce back loan and CBILS. So there are still some things around in terms of government support, but the majority of our more favourable the majority of our more favourable products are facilitated through the more traditional products through banks, alternative providers, and so on and so forth. So there's lots of options out there as we'll kind of jump on to in a second, but it's a key thing in mind, that something that we're always transparent with in the outset of our conversations with partners and businesses, is that things are a little bit more expensive, and it's really, really key for us to kind of broach that conversation from the outset. So the first one, just to jump into, is probably where we see the majority of our inquiries, and that is the business loan. It's very much, exactly what it says on the tin. It's a loan that's paid back in fixed monthly and weekly instalments. We've got, in terms of the loan amount, we can look anywhere from the smaller facilities around 1K up to those multi-million-pound transactions. In a similar respect, terms of facilities will range anywhere from 3 months up to a maximum of generally 6 years. Anything above 6 years in the current market is likely going to need an asset or some sort of security to sit behind it. Rates are always a driving conversation around loans, and we're obviously deemed in terms of what appetite we can see from lenders. Rates are really just down to the risk profile of the client, and that's determined by a number of key variables that a lender will assess. That would be your business credit of the directors that sit behind the business, trading age, bank account conduct, movements in the financials, balance sheet position, and so on and so forth. So all these things will be assessed upon an application basis, and will essentially determine what rate we can achieve. The majority of rates will be fixed. What we're seeing in terms of a figure at the moment for our kind of top tier lenders, so the cheapest lenders in the market, you're probably sitting at around 10 to 16% on average. We still do see some below that, but we do also see some at the other end of the scale if there are a higher perceived risk within that business, whether that's adverse or loss-making accounts and so on and so forth. Another key point that we always discuss with businesses and partners alike is personal guarantees. And again, to go back to the government support schemes, because there was 100% government guarantee sat behind the bounce back loan and CBILS and the initial part of the recovery loan scheme, lenders weren't actually allowed to take personal guarantees. But we have, like I say, pretty far past that position in the market, where we are back to a much more traditional environment, I would say, where guarantees are a little bit more prevalent in the market, where the majority of loan providers will request them. It is an unsupported guarantee, so it's not backed by any personal assets. It is essentially an underlying agreement between the lender and the director, that if the business was unable to repay the debt in certain situations, the director or shareholder may become liable for that. We do work with insurance partners who can provide insurance against that as well. So I think, yeah, just to give a little bit of insight in terms of what that looks like, is it is a kind of common question that we get asked about. Cool. So this slide just talks through a little touch on a case study that we completed a few months ago for a business looking to score just short of 300k. Was in this situation utilised for recruitment and general business development, but the loan, and probably why we see the majority of our inquiries within the space, is that it's very broad on its utilisation. So whether it's a manufacturing business looking for stock, or whether it's for materials, I should say, whether it's a retail business looking for stock, there's a broad use of funds that is accessible through a loan and is not tied into any specific thing that you need to spend that on. So when you're looking for prospective opportunities within the business loan space, if you think in some of your businesses or your clients, I should say, come to you and ask about loans and kind of what potentially they could achieve. So there's some key things that we would look at as funding managers in the market, that we would have a think about what a business could be eligible for. And the first key one is turnover. This is obviously a very important point for lenders, because obviously the revenue that the business generates, a business turning over 100k probably isn't going to get a 500k unsecured loan. It's deemed as unaffordable. We'll probably look at anywhere at the moment in the current market of 25 to 40% of turnover as a very general rule of thumb. We have lenders that sit below that, and also ones that can look above it as well. But that gives a general indication. Profitability, again, for those longer term, more affordable lenders, they will have more stringent bottom line affordability assessments. So a business that's profit making is likely to get access to more affordable and better terms than if a business wasn't profit making. So again, a key thing that you can look out for. And also existing debt. So we see a lot of businesses that come to us that are in a position where they may be struggling with existing borrowing, and it's something that we will always assess. If a business is very highly leveraged already, it may be difficult to secure further funds, but we may be able to look at that on a consolidation basis as well. Things that you can ask around as well, and what I always think about driving funding conversations is just being able to ask very general questions about plans for the future, whether there's growth planned within the next 12 months, how is that going to be funded, how is your cash flow position over the next quarter while you start this new project. Again, there's all these different things that you can ask about the business where funding may be applicable, or funding may assist in their plans or their growth, and so on and so forth. So we all know each business is going to be different. We will always spend the time to have a conversation with that business, whether that's through yourself as the introducer, or whether that's with the business directly. We will always spend time to understand that business and what their needs are, and what potentially would be the most suitable solution. But again, the more conversations you can drive around funding, the more ways you're going to be able to support your clients in that respect. Again, any questions throughout the webinar, just, like I say, please feel free to put them in the chat. Cool. So the next one that we look at, and where we are seeing quite a lot of inquiries from some of our partners at the moment, is through tax funding. And tax funding is exactly what it says on the tin again, a product that is utilised to spread the cost of tax liabilities. So lenders will provide funds to fund your upcoming VAT liability, your corp tax, or self-assessment. So VAT is the one that we probably see the most predominantly, just due to the nature of that coming 4 times a year. It's essentially moving that quarterly liability into 3 fixed monthly repayments. Rates can vary from 5.5 to 9%, again, dependent on the risk profile of the client. And the way I suppose the benefits of this is that obviously you're not having to fund that liability on time. Essentially, you're giving yourself a bit of breathing room in terms of being able to spread that over 3 monthly repayments. Obviously, a quarterly VAT liability may have a pretty significant hit to cash flow. Of course, in an ideal world, we would hope that a business would potentially keep that money for VAT aside in a separate bank account, but we understand that a lot of businesses might not be able to do that due to costs and unexpected scenarios and so on and so forth. So this product can be utilized to, again, give you that little bit of breathing room. What it also will offer the chance to do, and where we've supported businesses previously, is that it is a potential tool for growth. In terms of you being able to spread the cost of that tax liability, what you are able to do is retain that cash in the business. So rather than you having to fund that liability, let's say on the 7th of each quarter, so 7th month of each quarter, you're retaining your cash for longer in the business, of which you can then go and utilize to maybe spend on some growth opportunity, whether that is marketing or recruitment or whatever it might be. Having access to your cash for longer, and as long as you can make a positive return on that, it may be beneficial again for the growth of the business. Corporation tax is one that we see regularly as well. Obviously, a little bit less in terms of being an annual liability. Works in a very similar way where we can spread it over 6, 10, or 12 months. That rate's 10 to 16%. That'll be for the 12-month term. Again, will be drop as we get to a shorter period. And again, it works in a very similar way where you're essentially spreading the cost of that liability in a position where you don't need to fund it all up front. The self-assessment one is one that we probably see the least regularly, just obviously to just the nature of obviously how that falls twice a year. One that maybe a lot of partners or businesses maybe aren't aware of, that they can fund that through the business. And especially as we head up towards the end of July, where there may be some payments, there might be some potential businesses there that may need some directors that need some support. So this is a really quick case study that we put in place last year. A facility, I think we've renewed this one around 3 or 4 times, and this business was really struggling with their debtor days. They were struggling to incur. They were incurring surcharges each quarter, which were obviously at a pretty significant cost. We managed to get them back on track with HMRC by getting them essentially into a VAT funding position. They've then renewed this a few times and essentially moved that quarterly liability into 12 monthly repayments, bringing it in line with your other kind of payments, whether that's insurance, payroll, rent, etc. Some key things to look out for as well. So turnover, profitability, it is assessed like a loan facility. So again, a business that is in loss making potentially or a low turnover, again, there's difficulty there for lenders to be able to provide appetite for that. Also, this is always for upcoming tax liability. So if a business is in an arrears position, maybe from last year or a previous tax return, lenders won't be able to fund that on a specific tax funding product. It's always got to be something that's coming up, or within a potential kind of 2-week grace period that lenders will give. Anything beyond that, it is viewed as arrears. And again, things that you can ask for. We've seen a lot of success with partners is just through asking that question when sending out that tax return. Say, would it be worth having a conversation with Swoop around options on funding this tax liability? So, yeah, we have lots of conversations with businesses around the benefits of this against a potential time to pay arrangement. Some key last couple of points that I just want to make on tax funding. I think the time to pay can generally be a more cost-effective solution than facilitating a tax funding product. However, it is obviously very reliant on that HMRC being able to provide that time to pay. But also in a similar respect, it does leave you if you did go out of that time to pay, it does leave you in an arrears position with HMRC as well. And that can, and I've seen it before, where other borrowing opportunities have been impacted by being in a time to pay and essentially being in arrears with HMRC. So again, we can offer an alternative to that, obviously dependent on us qualifying for that product, but again, gives another string to your bow as an advisor to an option that you can offer to your clients. Perfect. So the next one just to touch on is, again, becoming an increasingly utilised product, and there's lots of businesses that we support with this, and it's something called an MCA, or a merchant cash advance. So essentially what this is allowing a business that is taking a high volume of revenue from their card terminal to advance against that revenue, essentially. You will generally be able to get access to 1 to 1.5 times your monthly revenue. And rather than there being fixed monthly repayments or fixed weekly repayments, you essentially pay back via a percentage of your revenue that you receive. So this can work really, really well for certain types of businesses that are taking a high volume of card transactions, who may be subject to general seasonality in terms of when they receive revenue and when maybe their products are in season, or whether it's nice weather and people want to go out and go out and spend their money. So having non-fixed repayments can also improve, obviously, the affordability within the business as well. So again, there's benefits of this in comparison to a potential loan facility. The way that it works in terms of the cost, interest is always front loaded. And I'll share a quick example with you after this. And the facility will run for 9 to 12 months. Obviously, there is no fixed term because you essentially pay back by a percentage. So as, let's say, your sales go up, your repayments will go up, but also if your sales go down, your repayments will go down in line with that as well. Obviously, for these businesses, it's very dependent on those card transactions, and retail and hospitality are two main sectors that we support within this, where there are generally a high volume of card transactions there. We also work with a lot of e-commerce lenders as well, who work in a very similar way, where you can leverage the online sales. So it doesn't have to be your physical card terminal, your online sales through Amazon, eBay, Shopify, etc., that we can look at. But again, it's relying on that card terminal. So your engineering B2B business won't be taking many card payments in store, and therefore, probably wouldn't be a product for them. So this is one that we completed on last year. It's a facility that was for a carpet retailer to facilitate some stock purchases. In terms of the rate there, it's 1.19 factor rate, which is attached to that 15,000 on day one. So the total to repay was just short of 18,000. And this lender, this business actually managed to turn around this facility quite quickly, because of the additional sales that were driven through those stock purchases. They managed to get a renewal for double their amount in a few months post taking this facility, which again allowed them to facilitate further stock purchases. They were comfortable with the repayments because they knew as they received payments, they would then make that back, make that to them. Key things to look out for: turnover is more of a reliance here than bottom line profitability, because they take repayments at source. They don't take repayments at the point of at the bottom line, essentially. So again, turnover is more important, and obviously it's very, very dependent on the sector that they operate in, and of course utilization of that payment term. So it is a little bit of a niche product in terms of that it's only relevant for certain sectors and types of businesses, but again offers a really good alternative for those. And again, things that you can look out for if there are a high volume of maybe card transactions or costs of utilization in terms of a card terminal. It's always a big thing that you can look at. Age of client is also another important one. Businesses trading just 3 months. If maybe you're a new start restaurant or cafe or something similar, you can get access to these products relatively early in the life cycle of your business. In comparison to loans, where the more favourable rates, you may need to be trading 12 months, for example. So again, another kind of note to keep in mind that we can look at those younger businesses. Brilliant. So on the last product, so this is something that where we're seeing more and more lenders enter the market of this type, so providing this type of product, and it's something called supplier finance. And this is essentially a product that allows businesses to spread the cost of payments to their suppliers. You can spread this over 3, 6, 9, or 12 months, for again, depending on the lender, depending on what appetite we can see. And you will only upload the suppliers and invoices that you want. So from a cash flow position, obviously you not having to, or potentially your supplier isn't giving you credit terms, you maybe having to fund that all up front to be able to get access to that material or get access to that stock or whatever it might be. You being able to spread that over a longer term, obviously, is going to naturally improve your cash flow position, where, again, you're retaining cash in the business for longer and you're given an opportunity where you've got flexibility on that as well. So it's not like every single creditor invoice that you need to pay is going to be utilised on this product, but only the ones that you want. And this again is a big contrast to a loan, where we work with lots of businesses who may not want to take on a loan, because essentially once you take on that, you're incurring the fees of drawing down on the facility. You're paying interest on the full balance from day one. It might be a case of something a little bit more flexible in terms of its utilisation is something that's more favourable to that business. So yeah, we've got lenders who work in different ways, and they can increase, decrease limits depending on utilisation. But the majority of them will work on a flexible or revolving basis, which can be very beneficial to businesses. It's not restricted just to UK suppliers either. If you're importing abroad, a lot of lenders can work with overseas debtors, overseas creditors, I should say, and work in different currencies as well. So it is similar in respect to a trade finance type product. And again, it's always relying on that external invoice being paid. It's not essentially one where you will essentially be able to draw down cash in the bank. It's one that, again, you need to use on external payments. So again, a product that we put in place last year for a logistics business starting a new contract, allowed them to essentially get access to a facility, spread the cost of payments to for some new vans, also to clear off some HMRC balance as well. So it worked well in respect that they could utilise that on a couple of things to really get that project up and running. And they've continued to use this as a revolving facility as well, which has been great. Things that you as an introducer can look out for as well is just general creditor payments. If there's any cash flow concerns as well, especially if supplier or creditor payments are causing concern. So yeah, there's a few different utilizations and things that you can spot. And what we will do, we'll assess it very generally in terms of what type of product that they would be eligible for within the supplier finance space, as we've got lenders who have different sets of appetite and can look at different ways of supporting businesses. But again, offers a more flexible option than a loan, and will give hopefully some a way of businesses improving their cash flow position as they potentially start new projects or might struggle with current supply credit terms. Great. So that was all of the products that we wanted to run through today on this Unsecured Masterclass. Hopefully that's given a little bit of insight in terms of the different products that we can look at, and also what type of funding we can do, and potentially hopefully where we can support. So see there's a couple here in terms of attendees. So just want to see if there were any questions at all off the back of those products. If not, like I say, if there are anything following this call, we will share the recording, and myself and the team will always be in hand to answer any questions that you've got, whether that's product or client based. But I'll just give a second to see if there are any questions. No worries. Perfect. Well, what we'll do, we'll jump off for now then, just as we hit 12. So again, anything that we can do at Swoop to support, like I say, hopefully this was insightful in terms of the different products that we can look at. And for us, we're always happy to gauge any questions that any of our partners have. And hopefully we can be supporting yourself and your clients in terms of securing funding forward. But look forward to seeing you all soon. Thank you very much.